Yes, indeed. Welcome to Digital Bytes, and today we're looking at the unintended consequences of negative interest rates. Well, in Switzerland last week, UBS introduced a charge of 0.6% a year for anyone that wants to deposit with them €500,000. In other words, you've got to pay to keep your money in the bank. Meanwhile, in Denmark, where bond markets go back to 1787, Denmark's third largest bank, Danske Bank, is now offering its customers the ability to borrow money for 10 years at minus 0.5%, effectively meaning the bank pays you to borrow money. No surprise there that house prices have reached an 11-year high. But this is actually coming at quite a cost. The total market value of banks across the world has now fallen by in excess of 20% since the beginning of 2018, representing a fall of nearly $6.8 trillion. In Germany, this pain is acute, whereby you're seeing Deutsche Bank and Commerzbank estimating the cost of negative interest rates is somewhere in the order of $3.5 billion a year. So how close are we to another banking crisis? Well, if more data on banks was actually held in a structured manner using blockchain, it would be far easier for regulators to carry out some form of risk analysis and testing of the potential systematic risks that the system and the banks are facing. Therefore, if one bank goes broke, what impact does that have on another bank? Meanwhile, banks are looking at blockchain technology to reduce costs, removing intermediaries, effectively digitising operations, their products and services, and so building in much stronger programmable compliance and regulatory controls. The actual conventional wisdom that low interest rates are the answer to boost economies is being challenged as never before. And in effect, the unintended consequences of low interest rates is that people may well start keeping their cash literally under their bed and slowing down the speed of money that moves around the economy and therefore economic activity. And low interest rates can clearly affect those of the retired who rely on interest to supplement their pension. And finally, what happens when interest rates rise, given the amount of debt that governments, corporations and individuals have, how on earth will they be able to afford to actually repay the amount of money that they've borrowed?